So let me be among the many who I'm sure will be welcoming you back to campus, Princeton alumni and families. I know you have a lot of options on Friday, on Reunions Friday, so thank you for taking us up on the opportunity to meet today. My name is Ilyana Kuzhemko. I am the co-director of the Griswold Center for Economic Policy Studies, founded in 1989 by Professor Alan Blinder. We support policy-oriented research in the Department of Economics, and in particular, we try to bring people from the academic, business, and government communities together to discuss economic policy. Among the events we sponsor are 2 major symposia a year in the fall and the spring, numerous book talks, awards programs for undergraduate research, and all of this is made possible by the generosity of Ben Griswold and his wife, Wendy. We especially enjoy, as part of our programming, our annual Reunions event. And it's a great honor this year to welcome back Blair Effron back to Princeton in conversation with our own Alan Blinder. So in the interest of time, I'm going to severely shorten the biography of one of my favorite colleagues, Alan Blinder. Beyond being professor of economics and public affairs here in Princeton, he served as vice chair of the Board of Governors at the Fed and was a member of President Clinton's Council of Economic Advisors. He is the author of 23 books, a graduate of the master's program at the London School of Economics and the PhD program in economics at MIT, and today, perhaps his most salient accomplishment is being Princeton class of '67. So I'm going to hand it over to Alan to introduce Blair and get the conversation started.
Thank you. We're using this one. That one seems to be okay. It's over here. All right, can you hear me? I think you can hear me. Actually, I'm a professor in a room this size. You can hear me without a microphone. It is my privilege, honor, and joy to introduce Blair Effron, a member of the class of 1984. Now, every class many classes sort of nickname themselves. I'm wondering if your class is nicknamed the Great Class of 1984, the Mighty, not the Orwellian, exactly. The Mighty Class of 19. My class sends me emails that says the Mighty Class. I wonder if they're all mighty. Anyway, Blair is a member of the class of 1984, and he's also a trustee of the university. So in some weird sense, universities are weird places. He's my boss. That's professor and boss don't usually go in the same sentence, and they don't really in this case either. Blair began his career in investment banking with a firm called Dillon Read. That firm went through a number of mergers and acquisitions, changed its names, et cetera. And Blair was there winding up as a high-ranking official of UBS in America. In 2006, with some partners, he founded Centerview, where he is still the co-CEO, or CEO, partner, whatever, the boss.
They all work.
He still leads the firm with his partner. Centerview, for those of you who don't know, is a leading, if not the leading, quote, boutique investment bank. Now, as I say that, I looked up. They have over 500 employees. I don't know, are you still a boutique when you have over 500 employees? It certainly started as a boutique, started as a small company. It is now not such a small company. Among the deals that Blair has been personally involved in are household names like General Electric, Time Warner, Fox, PepsiCo, Unilever, the list goes on and on and on. In addition to serving as a trustee of Princeton, Blair is on the board of the Council on Foreign Relations, vice chair, I think, is that right? Yeah. on the Metropolitan Museum of Art and on Lincoln Center. In my mind, that makes the trifecta. He's got the New York trifecta there down perfectly. And what it shows, in addition to people wanting Blair's wisdom on their boards, is his willingness to give of his time to good causes. Last but not least, in this political season, I think we should mention at least, but not dwell on the fact that Blair has been active in Democratic politics, as have I. But I want to emphasize, and I'm sure Blair agrees, this is not a political talk. We're not, unless severely goaded, we're not talking politics in this occasion. So I give you Blair Effron.
Thank you. Can you hear me? Here we go. It should be on. First of all, I must be getting up in reunion years because I see a lot of classmates here. In years past, there is no way they'd be up at 10:30 the night after the first reunion to see anything. Equally surprising to me is that Alan would invite me. I took his class my freshman year, and I can tell you, based on that performance, I never thought I would be here doing a one-on-one with him. That said, it is a pleasure to be here with Alan. He and Madeline are good friends of my wife and mine. Alan is an institution here. The Griswold Center really has been a phenomenal organization at the nexus of academia, policymaking, and business. It discusses all the key economic matters of the day. And simply for me personally, taking Alan's course freshman year really was my first exposure to the world of economics and business, and for that I'm very grateful. So what we're going to do today is about the economy. Let me try to level set a little bit about where I think we are, where we might be over the next 12 and 18 months, and then where we're longer term. The good news is the 4s and 9s won't be back for another 5 years, so my hazy crystal ball, hopefully you'll forget where we end up. So where we are, at least until recently, there had really been two camps of thought about the economy. The camp that was most prevalent was this notion of a hard landing, the idea that rates would go up, it would lead to a dramatic slowdown, even recession. And if you took a poll in my world of business leaders, up until kind of early 23, you would have seen that as the prevalent school of thought. Fast forward to middle of 23, and this question of a soft landing really came to the fore. Soft landing being interest rates go up, yet we can continue to be in modest, but a still growing economy. I had been in that camp for a long time. Actually, what's gone on is a third scenario, no landing at all. And I think it's fair to say that in the US, we have been resilient and robust economically. It would be hard to argue that the US economy at the moment is not the envy of the world. We stand strong, outpacing economies across Europe, China, anything in South America, even Japan. And I personally think we have good reason to think that this could continue. So level set for today, where are we within economy? One, labor market. We have had an incredibly resilient labor market, 27 months in a row of unemployment below 4%. That's the best record in 50 years. Two, the US consumer. Slowing a bit, but still really resilient, particularly if you look at the top 80% of the consumer universe. And it's important to note that wage growth for the past 12 months, each month has been 1% ahead of inflation. You should think that the consumer still has enough firepower, and in fact, personal balance sheets are better today than they were before COVID. Corporate strength. It's where I spend most of my life. I can tell you the corporate sector is as robust as I've seen it in my career, particularly on a relative basis to any other economy. Just in the past 2 years, the S&P 500 has expanded margins 120 basis points. Revenues have grown 14 straight quarters in a row, first time that's happened since 2009. And 80% of companies just in the quarter past, first quarter 24, surpassed earnings estimates. That's been a trend that has been ongoing. So those are the inputs, and it's led to really two big outputs. A stock market, which has been the envy, again, the envy of the world. We traded 20 times next year's earnings in a PE basis. The rest of the world trades at 13 times. That 7-point gap, the largest gap we've had also in 20 years. And then finally, and most importantly, GDP growth. We have grown in this country at a rate of over 4% since COVID. Last year, growing at 2.5% was still 100 basis points higher than an index of world economies. And very importantly, the only developed country that has had a trend line of growth higher post-COVID than before COVID. I think a big deal. So that's today. With that backdrop, what happens over the next 12 to 18 months? I personally remain optimistic. Granted, and Al and I will get into it, there are some unknowns. But if you look at most estimates, whether it's the Fed, whether it's CBO, Congressional Budget Office, they will have estimates of slightly better than 2% growth in 24 and 25. Every year we have seen these estimates, we have seen growth 50 basis points or so better than the January estimates for the year ahead. I think that's going to continue. Why does that continue? Corporate earnings and corporate strength. The fact is, among a large range of companies across many sectors that I deal with, business leaders remain generally optimistic about their businesses. They believe they will continue to achieve growth. They believe they will continue to expand margins. And they've gotten really good about being able to project their businesses. So when they say it, today it is much more credible than any time in the past. Employment, again, ought to remain robust. We're 2 million jobs shy in the country of available need. And very importantly, since COVID, I think we've all learned something important. It is a lot less expensive to hold on to your employee base than to have a large wholesale layoff, and then have to compete for labor, retrain, rehire, and figure out how to retain. And if you think about business cycles generally, since we've all been in school, at least most of us here, they've truncated. So when you hold on to employees, you're doing it for quarters, not many quarters, and I think that's a bet most CEOs are willing to make. Government-fueled tailwinds. I happen to be a big supporter of what we did to get out of COVID, $5 trillion of spending, mostly bipartisan. 80% of that is available to spend still, and most of that will actually be allocated over the next 3 years. That will be a big help. Then we have the consumer. We mentioned that the consumer had a recent slowdown. I would argue that most of that slowdown is because prices advanced too quickly relative to consumers' comfort. So they pulled back and there was a backlash. I think that's what you've seen rather than a weakening of the economy. And I believe that will come back to show good spending by the end of the year. If you look at important announcements, Walmart and Target recently said they're going to cut prices 5% or so on thousands of products. That will help, obviously, with inflation, and it will also help rebalance this supply-demand issue we have. Capital investment, 24 will show more capital investment by 150 basis points or so versus 23. And then finally, very importantly, and I'm a little bit tentative here because I have Alan, interest rates. If I have to be in camp that says the interest rate decrease will be delayed because we do have a robust economy, but I do think we will see a decrease over the next 12 to 18 months. The past 4 cycles where you had an interest rate decline, after the first cut, GDP growth was over 3% each time. The stock market went up 25%. The point is, the signaling means a lot. Our fellow alum, Jay Powell, knows this very well. You don't need to have 2, 3, 4 cuts to have a positive impact on the economy. So that's short term. Long term. Long term I have most confidence in because you're not going to challenge me. Who knows what's going to happen. I do have huge optimism in terms of where the U.S. is. We have a set of advantages that are absolutely unparalleled to any other country in the world. So let's talk about technology. 8 out of the largest 10 companies in technology are based in the U.S. 43 of the top 50 AI companies are in the US. We have this resident intellectual capital that all companies are spending big investments in tech to improve their businesses. If you look at what is going on, I mentioned margin and productivity. What is striking me actually more than anything is how companies of all sizes are able to generate more revenue because they have so much better data in which to make judgments. Secondly, we have a culture of innovation unparalleled. In the past 5 years, 3 million jobs a year have been created from companies that did not exist the year before. Energy independence. We are now a net exporter of 30% of energy. At my 23 union, we were 60% importer. Something that I don't think gets captured in economic models is the nimbleness of decision-making among corporate leaders. The fact of the matter is, if you look at most companies, they are so much better able today to take data in on a real-time basis, make judgments and course correct in their businesses. What does that mean? It means when they see a problem, they catch it when it has a cold versus turning into pneumonia. Let me give 2 more examples, companies I know pretty well, Walmart and Target. They get inventory data globally, literally by the day. When they see a trend, they are reacting within a week, 2 weeks, 3 weeks, huge impact to mitigating any downside, and we're seeing that across companies everywhere. Unsurpassed higher learning institutions like ours here. And then finally, a system of government. It's hard to argue that a system of governance based on rules of law, free enterprise, civil liberties, and balance between private and public sector isn't going to, at some point, win the day. So that's the outlook. I will point out, and we'll get into Q&A, obviously I'm my day job trained to look at the downside of everything. I worry about global hotspots everywhere. I worry about the economic impact of climate change. I worry about inflation being too sticky. I worry about trade. I absolutely worry about the federal deficit, and I absolutely worry about political dysfunction, which has hampered decision-making, policy-making. I agree, some people think no policy-making is probably a positive. I'm not in that camp. All that said, I end with, there are many reasons to be optimistic about this country. The fact is, we have a culture of innovation. We continue to train the best and the brightest, and because of that, including what we do here, I do think we will be the world's recipient of human capital and financial capital. So we'll get in a little bit of Q&A with that. If that's okay with you? Yes. Great.
Thank you very much, Blair. You got your mic on?
I think I do.
It's this one here.
Okay, I was a medieval history major, not technology.
No, I think it's on. I think it's on.
Okay, good.
Thank you very much. It's nice to hear a torrent of optimism in the current U.S. environment. And I don't want to spoil that. I do want to ask you a few things, though. It looks to a lot of us, and maybe it's a jaundiced view from watching CNBC too much, that market people are like focused on the Fed to the exclusion of everything else, as if nothing else matters. Would you is that wrong? Would you just comment on that? And if not, what else are they thinking about?
So, one, I do think that is the main focus, and I do think it's wrong. The fact of the matter is, we have a rate environment that is in the mid 5%. It has not retarded economic progress. The market in the short term is basing its decisions on when and if and how many rate cuts we will have. What I would say is, all that said, now the markets maintain a huge tailwind. I think Chairman Powell has done a great job navigating to the current state. And what you're talking about to me is a short-term phenomenon. Over the long term, I do think economic fundamentals, basic economic company performance come to the fore, okay? And The fact is, markets move now in nanoseconds, so getting this, the easiest thing to focus on is the Fed. But I believe if you were only focusing on the Fed, the markets wouldn't be where they were. I think that fundamentally, the markets portray pretty decent economic news.
So the markets are happy. Americans are not happy. I want to ask you a question that I get asked. I pick up the telephone and there's a journalist on the other end, and it's always the same question, which is, if things are so good, why are Americans saying things are so bad? Do you have a take on that?
I do. First of all, when that question's asked of me, it's generally in relation to the administration. I like to point out that, yep, numbers aren't so good, but Congress has a 15% approval rating. So the point is, people are angry at public officials generally. But if you look at what's going on with the consumer, the fact is, since 2020, prices of a basket of goods are up 50%. It's a very easy thing to know that when you go to the grocery store, eggs, chicken, milk are much more expensive than they were. You're not sitting there saying, well, wait a minute, my wages were up 1% a month over inflation, I should feel good. Two, I do think there is a narrative, a media narrative, that I'll equate to Muhammad Ali. Muhammad Ali used to say all the time, I am the greatest. Now, maybe he was, maybe he wasn't. But the more he said it, you believed it. What I think is going on also is the more the media and the more everybody says things are not good, the more it feeds on itself, and people don't feel as good as they should. The fact of the matter is, confidence indexes like the Michigan Index are higher today substantially than they were a year ago. But then I'd also say that inflation is a tax on everyone. Therefore, it is felt more strongly versus unemployment. I said that unemployment obviously is at historic lows. People don't think about that as much. That means 4% of the people versus 100%.
And let's interject this. People think unemployment is high now. They're telling pollsters that unemployment is high. They're telling pollsters that inflation is going up. Neither of those is remotely true.
I could give you as we all could, a large number of statistics that are plain wrong, including on the question of choice. Not to get 20% of the people think that the president is against choice. So I think it goes to a broader problem, which is how we teach civics, how we become fact-based, and all that said, don't underestimate the American public's smarts. When they tell you they don't feel good, I think you need to take that seriously. And I think they're going at something that is a big issue, which is putting food on my table is simply more expensive.
Let's move a little bit to the long run, where your optimism was even greater than in the short run. You didn't mention, but you only had a few minutes, you didn't mention artificial intelligence. And I see and hear estimates of the potential impact of artificial intelligence. I should say, I don't have any expertise in this whatsoever, so don't worry about what my views are. But I just hear views expressed ranging from, this is horrible and a threat to democracy and to civilization and so on, to this is going to be one of the greatest things for productivity in the history of mankind. That's a pretty wide range. What's your view on this from where you sit?
So I'm always a big believer in progress. When we went from the horse to the car, look at all the ancillary benefits, creating highways, creating new cities. When we went to the internet, the same thing. I look at AI, I think the market is absolutely underappreciating its positive impact. I can make the argument, and I've a lot of studies to point this out, that over the next 10 years, it'll add another $1.5 trillion of growth to GDP. The fact of the matter is, there will be disruption, but I think we have such a nimble economy, Alan, that over the longer term, people will be able to be more productive. They will have skills that will enhance their ability to get paid. And you will create new industries that we can't consider today. So there will always be pockets of disruption, particularly in the shorter term, but I think we have reason to think we should be optimistic longer term. And I understand some of the more Orwellian issues around it, but just from an economic perspective, I see it as a plus.
Yeah, but let's come to the fakery. We were just talking a moment ago about people having, from the media and elsewhere, grotesque misconceptions of what the economy is actually doing and what it's like now. One thing I think we know about AI, I already confessed I know nothing about it, is that it's pretty good at fakery and getting better and better by the day, if not by the minute. And it strikes me, I'd like to hear your view, that this is something to worry about. It's in the hands of a relatively small, I think, number of businesses, how this is going to evolve, that don't have public oversight. Maybe that's a good thing or a bad thing, depending on your view. But in any case, don't have it, and they will do what's in their profit-making interest, presumptively. And I'd like to hear what you say about the fakery problem.
So I think it's a huge problem. And I think it's something that we will see in November in this election and thereafter, creating potentially big issues and noise. One. Two, I do think there is enough support from important private sector companies and the government to figure out appropriate regulations. Everybody says, how do you, that the private sector has moved so far beyond the public sector's ability to regulate? Partly true. So when you talk about the corporate sector doing this, I believe the corporate sector will be responsible. Leaders of these companies are responsible. So the profit-making motive will be there, but they pay attention to guardrails. I'm on something called the President's Intelligence Advisory Board. We spent a lot of time discussing what these guardrails will look like. You're going to see legislation, bipartisan, that will be putting up guardrails. The issue, to me, is not the companies that we could all think about as being problematic, the Googles and Microsoft. The issue is, how do you keep technology from bad actors, be they individuals or states? That is something that we don't have an answer to, and we should all be, as you point out, appropriately concerned.
I am.
Yeah, no, 100%.
And as you said, starting in November.
Yeah.
I mean, we already have, Scarlett Johansson is suing whoever she's suing about imitating her. And that's just the tip of the iceberg, if that. One other long-term issue I'd like to hear you say something about. You mentioned in passing at the end something that I hardly hear out of any business leader's mouth anymore. But when I was in the government 100 years ago, I used to hear it every millisecond, which is the budget deficit, which is certainly in much worse shape now than it was when I joined the Clinton administration in 1993, and yet it seems like nobody's talking about it.
They will. Okay. The budget deficit is a bit like a cancer versus a heart attack. The point being, no one deals with it when it's a cancer. We are very good about dealing with heart attacks. There will be a moment, I have no idea when the budget comes back to bite badly. Right now, if you think about our deficit, we're spending, out of $6 trillion of government spending, it's $700 billion goes to interest expense. Why? Because we have a low interest rate environment. We've had it. As this debt rolls over and you start to think about 4% and 5% debt, that number goes up to anywhere from $1.5 trillion to $2 trillion, taking a third of our federal budget into a wasted category. I also think that as we've had a strong dollar, as we've continued to have 80% of global trade be used in the dollar, we've had a safety net. You can make arguments that when these trends change, they change very quickly. So I do believe that the debt has got to be, whether it's a Trump reelection or a Biden reelection, the focus on fiscal discipline is a must. Biden's last piece of legislation was designed to bring the deficit, long-term deficit down $1 trillion. You still end up in 2030 with 130% debt to GDP. It is not sustainable. Yeah. And I'd also say this, business leaders focus on what they can get done. There was something, in 2012, there was a huge effort among a bunch of CEOs, a bunch of leaders. There was a debt commission with people from government and private sector on it, and came up with a set of proposals on what should happen. Nothing was implemented. My point being, people focus on where they can make progress, and I don't see Congress on either side of the aisle making a lot of progress until they are absolutely forced to.
Right, I agree with that. Let's go back to your cancer heart attack analogy and a confession of what I was dead wrong on. When people ask me this question that I just asked you years ago, I said, you're not going to see any political force to reduce the deficit until interest rates go up, suggesting that when interest rates went up, you would see some political force. Well, you know, home mortgages went from 3 to 7 in a relatively short time, and in the political world, barely a peep about it. So that's one version of what the heart attack might have been, a big climb in interest rates, and it seems to have done nothing in the political world. Certainly people that are paying 7% mortgage rates instead of 3 have noticed this, but it seems to have done next to nothing in the political world.
It will, Alan, at some point, it will weaken the dollar. It has to. And at some point, interest rates will not be responsive to inflation. They'll be responsive to the deficit. And that's going to be a moment where the markets get hurt. Businesses and business leaders across the country will be beating the drums. And I think it will lead to appropriate action. Just keep in mind, under the Trump administration, deficits went up $8 trillion. Under the Biden administration, another $4 trillion. Yet the argument we had last spring, just several months back, was about holding the deficit flat. Okay? Because again, there's no... Deficit, not the debt. I understand, but the point is one leading into the next, right? The point is, until we actually see the impact on a day-to-day basis, it will be hard to react. It's inconceivable to me that over a period of time, and I have no idea when, it could be tomorrow, it can be in 10 years, that we won't be dealing with this issue.
If Trump gets elected, God forbid...
I'm not political.
No. Can he con the American public into thinking the deficit has gone away when it hasn't? He's passed off a lot of untruths.
So let me say this about Donald Trump. He is obviously incredibly politically skillful. He has convinced the country that his economy was better than Joe Biden's. Joe Biden had 15 million jobs. Trump had 4 million. In the third year of the Trump administration, growth was 1.2%. In the third year of the Biden administration, it was 3.4%. More manufacturing jobs, a better stock market. The point is, he is very good about talking about economic accomplishment. Now, I will tell you, the Democrats could learn some of that lesson, because honestly, talking, the language and the words you use for the economy and for business certainty and confidence matter. And I know that the administration today keeps saying, look at my accomplishments. Great, but you can't knock business leaders or knock companies in the nose and still have the same message. I think Donald Trump is very good about speaking in a pro-business, pro-economy way that he gets credit for. Again, the facts don't support it. Finally, his deficit, as I said, his deficit increased higher than Joe Biden's. And by the way, his economic plan makes no sense. The idea that you would have 10% tariff on every good That's a $300 billion tax on American consumers. It's 600,000 jobs at risk, and it's a half a point hit to GDP. But he still talks about his prowess.
You and I are both more than old enough to remember that when he first ran for president in 2016, he said that not only would his wonderful economic program reduce the budget, balance the budget, we'd actually pay off the national debt. Remember that?
I certainly do. I certainly do. And
if you can get people to believe that.
He and Muhammad Ali are pretty good at it. And I've been, honestly, joking aside, that's the issue, that it's part of this is the responsibility of all of us, everyone in this room, and leaders across the country to just make sure we're dealing with the right set of facts. And I think that there's a level of fatigue that rests in the private sector where the voices generally about facts are more quiet this time than they were in 2016.
Let's hope. I want to shift topics. I said we weren't going to talk politics, and I drifted into that a little bit. But it was the economics of it.
It wasn't politics.
It wasn't politics. It was economics. I want to ask you about something else that's much more in your bailiwick, which is how you see the relevant or optimal, whichever, skill sets of a CEO changing from 1984 to 2024. It's a rather different world now than it was when you graduated from Princeton. There were CEOs then and there were CEOs now. But I think they have to do different things. But you have a better window on that than I.
Great question. Very simply, the CEO today is much more talented because they have to be. No, I mean this. They've learned, okay?
Even the ones that didn't go to Princeton?
No, not those. To be a CEO today, you have to be so many different things. You have to be diplomat in chief. You have to know what's going on around the world. You have to be a data analytics analyst. You have to be a motivator of people. You have to be able to make 80% judgments on 20% information. You've learned to operate in a more volatile, complicated world than ever. When I got out of college, you fundamentally had a business. The markets didn't really hold you accountable like they do today. So you could not necessarily worry about next quarter. And by the way, not about it, as opposed to 3 years and 5 years. But the point is, performance was not punished like it is today. If you underperform as a company, you will not have your job. Or rewarded, absolutely fair. But the point around all this is, the CEO today is dealing with a set of complexities that never existed. Think about the societal questions that a CEO is expected to answer to. Anything around DEI, any issue, and you're going to create havoc no matter what you do. So a client of mine is Target. Target lost a ton of business in red states last year because of some issues they did around DEI. That's a big deal. Disney in Florida loses tons of business. Budweiser beer, okay, it's hard to knock Budweiser, yet it happened. So the point is,
especially at a reunion.
Exactly. So I just think managing today is much harder. And then don't forget, the typical size of an S&P 500 company today is 25 times larger than it was when I graduated. Simply the scale of these enterprises is such that it's a really unusual skill set. And yet they do it, and they do it. It's the thing that gives me the most optimism about where the country heads economically. We're good managers.
That was on your list, I noted, of 3 things at the end that were the secrets to, not the secrets, to economic success of the United States, the managerial,
it's hard, again, you can't put it into an economic model, but it's there, and it's having an impact.
And the great universities, I wrote it down. You didn't exclude other universities. We have more than one great university.
There's other good ones.
Yeah.
And one great one.
That's right. And the rule of law. I'd like to come back to that, because the rule of law seems to be under two-part question. First, the rule of law seems to be under some threat, or at least at minimum disrespect, and it's not limited to Donald Trump. Secondly, slightly related to that, one of the accusations you hear from the political right, I don't mean the crazies, but the normal political right, is that the Biden administration has been over-regulators within the rule of law. And they haven't, the crazies think that he's violated the Constitution or try to get Donald Trump assassinated or something like that. I'm not talking about that. I'm just talking about what we economists and business people have been talking about as economic regulation forever. And he's been accused of doing too much of that.
So, a very nuanced question, and here's why. The facts will show that Donald Trump and Joe Biden increased the number of regulations by the same amount, about 4% from the beginning of the administration. Yeah, exactly. Okay, about 4%. One. Two, everybody in my world talks about antitrust. The fact of the matter is, under Donald Trump, 2% of all deals had a second request, means you have to look at it more seriously. 2% under Joe Biden, and actually Donald Trump had more cases go to court. All that said, you have to look at where the regulatory regimes have changed. And I do think there is some truth to the idea that the goals of the Biden administration are such that they regulate in areas that make business investment more difficult to employ and get done quickly. So when you think, 100% correct, okay? So we're in this country now, there's 7 big hydrogen carbon capture facilities being built. It's taking a long time just to get the approvals, and with legitimacy, there's a frustration. We have the CHIPS Act, building in Ohio, upstate New York, Arizona, huge facilities, 25,000 jobs in Ohio, $25 billion factory. The fact of the matter is we can't get a shovel in the ground yet because of some of the regulatory regimes that have been in place. So I do think it is fair to say it hampers business formation and investment, but you're doing it as a policy choice. You're doing it because the EPA says climate's a real economic issue. And the fact is, it is. Okay, so when the president says we're going to restrict drilling, which is in Alaska, there's a reason he's doing it. And if you believe in the long-term economic future of the country, you actually know you need to get climate under control. So it's not done just because you're a Democrat, and therefore you need to have more regulation. There's a policy choice involved.
I think it's time to open it. We've raised a lot of questions here, and you've answered them very well. I think it's time to open to the floor.
Dave Zucker.
Was that a member of the mighty class of '84?
Mighty class of '84.
Thanks for coming. That's great. Really quick, you mentioned, I think, between 0 and 10 years for a reckoning with the growing federal deficit. What exactly is that going to look like? I mean, is it bond vigilantes and 15% interest rates? Is it runaway inflation? Is it a contraction? What will we see when we get a reckoning?
The answer is, Dave, we have no idea. We don't. But what we do know is it's any of those outcomes are entirely plausible. A runaway inflation, I do worry about the bond markets, and you will hit a point, for example, where people simply decide they will not buy U.S. Treasuries at any cost. Okay? I'm just not going to do it. When that happens, it's a really bad day. You can make the case, we've already seen liquidity being challenged in the Treasury markets. I think that's the area where you'll see it easily, and once that happens, in nanoseconds, you'll see the markets violently correct. and people react. If I go back to 2008 and the Great Recession, Congress, in its wisdom, voted down the initial $787 billion package of stimulus. The market the next day went down 700 points. What did Congress do? They got together that night and passed. You're going to see that kind of event that will lead to a renewed aggressive focus on the balance sheet of the country. Keep in mind, I, like most people, think the base case for interest rates is they come down over time, that the road to 2% inflation is a long one, but we get there. We peaked at 9%, we're down at 3.4. The fact is, if we are wrong and rates stay where they are, the next move for rates goes up, because rates won't stay here. They're going to go north or south based on economic activity. And you can then start to say, people will absolutely start to focus on what it means to be financing the country at 5 and 6% versus 0 and 1%.
Just to chime in.
By the way,
slightly,
you taught this course. Why don't you answer?
You're the one that's answering the questions here. I'm asking them. I just wanted to add that I believe the only thing that is in dispute, or whether it was said by Yogi Berra or Niels Bohr, is one thing you should never try to predict is the future. I don't believe there's another quotation that is so disputed.
Yeah, apropos for both of them. Back to the market's view of the economy, as we know, the market today is totally schizophrenic. You have the Magnificent Seven mega cap tech stocks, and then the S&P 493. And the Magnificent Seven are going big guns, and the 493 are kind of blah. And the last time that happened was the early 70s with the Nifty 50. Which ultimately ended with the market crashing and staying crashed for a decade. Where are we?
I'm not going to try to predict the stock market. I just want to add to your point that, as you may know, the market cap of quite a few of those seven exceeds the market cap of any other stock market around the world. So it's really quite an incredible concentration of asset value. And I think it's not seven anymore, right?
Five.
We're down to five?
Five.
Yeah, we're down to 5 companies.
Now, NVIDIA's market cap is larger than the market cap of the German stock market. Yeah. So it's a fair question. I have no idea where the market goes. What I will say is the S&P 500 multiple at 20 times is pretty good. Two, the economic performance broadly, not just these tech companies, is, as I said, pretty good. But what we saw is the potential for a lot more volatility in the markets because of the concentration in these companies. So if you go back to mid-22 through 23, the tech sector, particularly these big companies, they took it on the chin. So I focus less on the day-to-day volatility, which is absolutely there, and more on the underpinnings of the economy and the underpinnings of cash flow and earnings power, to say that for the time being, we're pretty good placed. I can give you 10 things why we won't be. But the fact of the matter is, investing today is done very differently. The idea of an active investor where you do research and come up with an idea doesn't exist. It's all computer trading. And it's much easier to focus on the biggest companies with the most volatility if you are a quant, because that's what's going to give you the most, quote, alpha, the most potential for outperformance. But the basic groundings of the market, I actually would say, support a more broad-based tailwind the past few years, and not just the Magnificent Seven or now the 5. It's a fair question.
I'm going to make a short prediction and ask you to react to it. One day, just the other day, NVIDIA reported better earnings than expected. One day they're going to report worse earnings than, I don't know when that is, than expected. What happens then?
So I was wondering this Tuesday, they reported Wednesday after the market, they went up 7%. The day they miss, and they will, the market will be down 800,000 points. Okay?
I thought you might answer.
Oh, absolutely. I mean,
I was
it's-
going to answer something.
but it will be dramatic
And it will
swift.
happen sometime.
It'll happen sooner than we think, because it always does.
I have the mic right here.
Where are we going?
Right,
Yep.
right in the middle. The Heritage Foundation's been working hard on
Get a little
Project
closer
20
to your mouth.
Project 2025. The Heritage Foundation been working hard on finding ways to make the federal bureaucracy more responsive to the administration, if it is a Trump 2. My question, both to Blair and Alan, is what do you see as the scope for the next a Trump 2 administration to make the Federal Reserve more responsive to the White House? And if they were able to do so, what would that imply for the debt picture down the road?
So, good. I believe, one, the Trump administration will understand the power, the levers of government much more effectively than they did the first term. They know how to make things happen. Two, however, when it comes to the Federal Reserve, there are today a wide range of congressional leaders, particularly in the Senate, who think it's an absolutely nutty idea to let the Fed. Mike Lee, who's a very conservative senator from Utah, came out right away. That's nutty. We won't let that happen. So I don't think it will. Now, if it did happen, and an administration says, no matter what's going on, I want interest rates to be at 2% versus where they are, havoc. And there's nobody in their right mind economically who doesn't understand that, which is why I think this is one area where we will be protected and the Fed will maintain its independence. It's just too ingrained into the system for all the right reasons. But we're talking to a vice chair here, so what do you think?
I basically agree with that, but let me amplify that and then add an aspect in which I am worried. I basically agree with it because, in addition to the reasons that Blair was alluding to, which you could call good government reasons, quite a few members of the Congress understand that the Federal Reserve serves a valuable role to them as a whipping boy if things go wrong in the economy. I'll tell you a short story, a very short story that Paul Volcker, the great Paul Volcker, told me years ago. A congressman visited him in his office at the Fed, and at the end of their conversation, this is when interest rates were 20%. A congressman visited him, and at the end of their conversation, Volcker said to the congressman, "Would you like me to invite in the Fed photographer? He can take a picture of you wagging your finger at me." And that's deeply symbolic of one of the roles, not the most important role of the Fed. So I think they get some protection from that. Otherwise, the electorate would blame the Congress. I'll tell you the one thing I am worried about, and I'm not hallucinating this because Donald Trump brought it up when he was president, which is there's never been a test in the law. Let me backtrack one. It's pretty clear he can't remove the chairman of the Fed. There's never been a test in the law about demoting the chairman of the Fed. The law basically reads, as you no doubt know, that the president can designate one member of the board to be the chairman of the board, and that's Jerome Powell 75. That's his proper name. But at one point, when he was president, Trump talked about demoting him to a member of the board. He can't kick him off the board. That's never been tested in law. Just the act of that, I think, would cost the Dow more than NVIDIA missing its earnings estimate. It would be a potential catastrophe, just if he starts doing it. And he doesn't need permission from Congress to start doing that, to try to do it.
Can you hear me? Yes. So I am just going to ask a political question. Sorry about that. You had mentioned, or at least this is my sense, that the business community, the leaders at the elite institutions are not as opposed to Trump as they were initially in 2016. We all know the poll numbers don't look great for Biden, despite looking okay for some of the Democratic Senate races. And as you know, as Alan pointed out, there's just this sense that the economy is so bad when the numbers aren't, don't paint that picture. In your estimation, how much of this is Biden specific? You had mentioned earlier it's very important how you speak to the business community. Trump has that knack. I don't think anybody would say Biden's, speaking skills are his strength. And there are these whispers of like maybe Biden won't be the candidate. Like in the business community, are those whispers there as well? And how much do you think some of the frustration with the business community or with Biden per se is Biden specific and not so much about?
All right. So let me, first of all, correct a nuance of what I said and what you think I said. What I said is the business community was fatigued in terms of using its voice actively, point one. Point two, a very unscientific poll of what I think business leaders will do. I would tell you among the S&P 500, among the S&P 50 companies, 2/3 or more of the CEOs will vote for Joe Biden, okay? Without saying so. I will tell you, is that different than 2016? The same level, but there's more fear. Okay, now, nobody wants to be taking on, as a business leader, Donald Trump. People remember he went after Harley Davidson, he went after Apple, everything that he was doing. But I'm struck by the idea that two leaders in oil and gas of two of our largest companies in the world, without naming them, will be voting for Joe Biden for one reason. I said, why would you do that? Because I believe in democracy. I'm not putting it at risk. So that's there. Now, nobody talks, the discussion's over about, we have two candidates and that's going to be our two. So the question becomes, can Joe Biden do a better job defending his record? If people actually listen to what he has said since the State of the Union, he's been on the road 3 days a week, and he's actually doing a pretty good job defending his record. He really is, and he's taking credit for things. The fact of the matter is there's a sour mood, and it is really hard you're speaking to the wind when you have that kind of mood. It's going to be a long 6 months. Polls yesterday showed tightening. A Quinnipiac poll, which is well regarded, showed a tightening. But I will also tell you, I do believe, and the administration's putting a program together, of having business leaders, people that we all know well, starting later this summer, speak on behalf of, they'll never endorse, but speak on behalf of good policy and why that means a Joe Biden reelect is something that should be considered. Again, business leaders, for all good reasons, will never endorse, but they will be part of that. I think Joe Biden will benefit from having others speak on his behalf as well. What do you think?
Hi. I want to
I'm going to pass on now. You have a much better ear onto that than I do.
Sorry, I thought you were waving at me. I want to go back to the ability of AI to create fake news. And what you said was we need guardrails and bipartisan legislation. So what do you mean by guardrails? Is that regulation? And how in the world are we going to get bipartisan legislation, particularly before November? And is there any economic incentive in combating fake news?
Okay, so let me suggest, first of all, I talked about political dysfunction. The fact is, we've had more bipartisanship the past couple of years than anybody actually appreciates. Infrastructure Act, CHIPS, IRA, not going off the debt cliff. So there is bipartisanship when needed. There are 3 things that Congress agrees on. We don't like tech, we don't like China, we don't like higher institutions of learning, okay? This falls, so 2 out of the 3 AI hits, China and tech, okay?
Our biggest major in the graduating class of 24 is computer science, so we're hitting 2 of the 3.
2 of the 3, there we go. So I believe, it won't be this year, but irrespective of where Congress is in terms of control, irrespective of who's in the White House, there will be legislation that says in certain parts of, there will be legislation that says technology going to country X, Y, or Z is not allowed. There will be inspections of, there's so many different things that go in. A car has 200 different computers now. There will be inspections that are laid out. There will be guidelines that we put to companies, the biggest companies, to follow, and you will see this happen. Now, to Alan's point, I'm talking about good behavior among responsible companies. There, unfortunately, is going to be a lot of access to everything around AI that has nothing to do with whether Google is a good actor or not. But there will be legislation.
I'll just pipe in on that. This is maybe the first thing we disagree on. I think in this election season, seeing bipartisan legislation in that area to combat fakery, for example.
It won't happen before November. I mean, after.
Oh, okay.
No, I'm saying nothing happens this year.
Okay, we're not this. I thought I finally found something we disagreed on,
No,
but
nothing
we
happens
don't.
this year.
We're agreed on that.
Right here, I have the microphone. I want to stay on the topic of regulation. First of all, thank you for the presentation today. Stay on the topic for regulation for a second. I'm interested in specifically European regulation. There is a very minimal political repercussions for the Europeans to regulate extraterritorial outside their jurisdiction, especially American tech companies. I agree with your point that America's dynamic. What is the impact on European extra-jurisdictional regulation on the American machine?
You want me to answer that?
Well, I'm happy to go, and then you go. Okay, so what I would say is that question is spot on and accurate, and I would argue that one reason Europe is growing at 1%, one reason that Germany is in recession is just because of what you're talking about. They are making it, from a regulatory body, you have so many different regimes that can get involved, that they have gotten, they are out of balance between what it means to promote growth and investment versus retard it in every industry. So I mentioned the gap in terms of valuations. It's actually pretty apparent, and it's one reason that the biggest companies in Europe continue to expand their businesses either through growth or through acquisition everywhere but Europe.
I'll just add that this is not unique or new. The rich European countries have been more regulatory in general in almost any sphere you can think of, prominently environmental, but not only environmental regulation, than the US. In the US, we still have this strain that anytime you propose a regulation of business, somebody calls you a communist. You don't really hear that much in Europe, and they just have a different attitude. So to your question, I think a reasonable expectation is that the Europeans will continue to be more regulatory where they can. And they're frustrated a bit, this is the sense of your question, by a lot of this stuff in tech, in particular social media, is coming from America. And electrons don't check in at customs, at passport control before they cross borders. So I would expect you're going to keep seeing this.
Yeah, but just take the banking industry. There's Basel III, which says how much capital a bank needs to have in its balance sheet. U.S. banks appropriately complained that it was getting too aggressive and it would hurt lending and business activity. Congress agreed, including more progressive parts of the Democratic Party. The Federal Reserve agreed, we are doing the right thing. Europe, nothing. They're keeping high restrictions. It is going to make them less competitive in funding economic growth.
Yes.
Being appointed somewhere.
Yes, I'm up here. Yeah. Laurel McFarland, 84. I want to ask you both a question about the future economic prospects of Princeton University taking a market view. Do you think as a supplier of research and human capital to the economy, do you think they've been making the right strategic investments and decisions in recent years and in the years ahead?
I guess I should start with that. Well, maybe you're a trustee. I'll start.
Definitely.
I'll start with that. Leaving aside the very salient fact that our campus has become a construction pit where you can barely move more than 100 feet in any direction without encountering a barrier. I think the priorities, to the extent there are priorities, the priorities you need in terms of the research that comes out of this place are made by the faculty. Individual. Chris Eisgruber is not telling us, and the trustees are not telling us this is what you should work on. There is a little bit in terms of where funding at the margin may go, but the truth is this is an extremely wealthy university. And if you have a good idea and it needs some research support, you almost certainly can get it, no matter what that idea is. So I think we're in a leadership position. We're not the only leaders. There are a couple of universities north of here that are doing silly things, but still have good research. But the university has been supple over the years in moving to, first there was, I'm old enough to remember when microbiology was a nothing and then became a big deal. When I graduated, well, I think even when Blair, no, I don't know, Blair's so young. Certainly when I graduated from Princeton, you couldn't major in computer science. It didn't exist. What, when you?
I have medieval history. There were people
And now it's our biggest major, and so on. And so the university, in terms of its research interest, evolves as is appropriate without restrictions imposed by the administration or the board of trustees or anyone else that thinks they have greater wisdom than the faculty. That doesn't mean the faculty always gets it right. I'm not going to name names or name research projects. It's not that everything is one of the golden eggs that the goose lays, but by and large, the environment for research at Princeton is excellent and has every likelihood of remaining excellent.
Let me follow on that.
Please.
Because I do spend a lot of time on that question. I think everyone here should be incredibly proud of what this university is doing with investments. I chair the Grounds and Building Committee.
Oh, boy, I'm glad you didn't start with that.
The fact is, we have 3 million square feet of building going on, which is more building than the entire campus was beforehand. Where is it going? It is going to a quantum institute. It is going to climate, nuking. It is going to a complete redo of engineering. It is going to 2 new colleges, which is 500 students per college, and we should have more. The fact is, Chris had a goal of having us #1 in every department when he got here. In chemistry, we were not top 10 when he got here. We are now #1. So the fact is, we have a lot of money, but we spend a lot of money, and we spend it well. I will also tell you, I am absolutely blown away with how eagle-eyed everyone is who is in control of the budget here about spending in a disciplined way. We beat up vendors like crazy, okay? So the point is, we should be proud that we are spending our endowment for this generation rather than safeguard. We always have this debate. Should we be taking more of the endowment and not spending it for the future? You don't want those gaps to increase. We can either choose to be Williams and Amherst or choose to be one of the best institutions in the world. I choose being one of the best institutions in the world. And we are more excellent here today in what we do than ever. And I say this as objectively as possible.
My only request is you don't follow this by another 3 million square feet once this is over. Thank you.
Going to inflation targets. Right? 2% is the declared target, but should that be the target? Should it be 2.4? And how would markets react if the Fed changed the goalpost?
I should probably take that. 2% became, for maybe not such fabulous reasons, I'll come back to that briefly in a second, the worldwide standard. The Fed was one of the late adopters of a literal 2% target, although I must say before that, when the Fed was not declaring any target, the market view was between 1.5 and 2 was what the Fed was shooting for. So it wasn't like 2 came out of the blue and stunned everybody. It didn't. When 2%, there's a reason it's not zero. There are reasons it's not zero having to do with measurement errors and a bunch of other boring stuff that I teach my students that I won't go into now. But one thing that I do teach them that I will go into to answer your question is when that target was adopted, and remember it was adopted in other countries before the United States. We came late to the party. The view was that worrying about the lower bound on interest rates, how low could you bring interest rates in a dead economy in order to try to stimulate it, was not much of a worry. That there was Japan and there was nothing else, and Japan was sui generis, and we didn't have to worry about that. What we and many other countries have learned since is that the effect of lower bound on interest rates, which, by the way, for the Federal Reserve was not zero, but the Fed decided it was zero. The European Central Bank was negative for many years. So was the Bank of Japan and many others. But there is a limit to how low you can make interest rates as you try to stimulate the economy. What we've learned since then is that those instances where the lower bound is binding and you get stuck and you can't do anything more with interest rates are much more common than we thought back in the 80s and 90s when the 2% became the sacred number. So I think, and many economists think, not every, but many economists think, but I think a higher target would have been a better choice when we made it. However, we made it. And if the Federal Reserve was now or soon to say, you know, we're not really shooting for 2%, we're shooting for 3%, that would be a terrible signal. Very destructive of the credibility of the Fed. To your question, I think the markets would take it very badly, thinking if they went from 2 to 3, why won't they go from 3 to 4? So for better or for worse, and I've just confessed I think it's a little bit for worse, I think we're stuck with 2. The one commercial I'll give you, and I'm going to write about this one day in the Wall Street Journal, probably after the election, is picking 2.0 was foolish. It should have been 1.5 to 2.5. To think that any central bank can control the inflation rate to the decimal point is, as I just said, foolish. Had the Federal Reserve had, in 2012, which is when it picked the 2% target, picked 1.5 to 2.5, which is still 2, everybody would have called that 2, it never would have worried in the pre-pandemic years that inflation was too low, because it was running 1.6, 1.7 or something. Like, who cares that that's not 2? But the Fed was taking that 2 number, 2.0, much more seriously than I think it should. You want to add anything to that or subtract?
Nope, I think I agree with you fully.
All right, so I think that's going to have to be our last question. A huge thank you to Alan and to Blair.
Thank you, Blair.